There is a version of investment property investing that looks clean on paper. Rent minus mortgage repayment equals monthly income. Claim the losses on tax. Wait for capital growth. Repeat. That version of the numbers is not wrong. It is just incomplete. The items it leaves out are the costs that catch most investors off guard, not because they are hidden, but because they do not appear in the simple version of the calculation. We split investment property costs into three phases. Entry, everything before your first tenant pays rent. Holding, every month you own the property. And exit, the costs of selling when you eventually move on. Most beginner spreadsheets only model part of the holding phase, and even then they only model the loan repayment. This is how costs that were always there manage to arrive as surprises. Entry costs start with stamp duty. In Victoria, investment purchases do not qualify for first home buyer concessions. The full rate applies. Use the State Revenue Office calculator rather than copying numbers from a blog post, because the rates and thresholds change. Then add conveyancing fees, building and pest inspections, a strata or owner's corporation review if the property is an apartment, and your loan establishment and valuation costs. By the time you reach settlement, the upfront bill beyond the deposit is typically $30,000 to $45,000 before you have collected a single week of rent. Settlement is where all the entry costs land in one place. Stamp duty, adjustments for council rates and water, legal fees, bank fees, any lender's mortgage insurance, they all appear on the settlement statement together. This is the moment most investors understand for the first time that the deposit covered the property, and the entry costs covered everything around it. The holding cost mistake is treating a property as only negative by the gap between rent and mortgage repayment. The mortgage is one part of the system. Add council rates, water charges, owner's corporation or strata fees, land tax, building and landlord insurance, and property management, which typically charges a weekly percentage fee plus a leasing fee when tenants change, plus inspection fees and monthly statement fees. Then add repairs and accounting costs. In our cash flow example, a property renting for $600 a week, $31,200 a year before vacancy, has $45,000 in annual costs across those categories. That is a pre-tax rental loss of $13,800 before the principal repayment. Two costs that grow without warning: land tax and strata Levies. In Victoria, land tax is based on site value and ownership structure. As values rise, the bill rises with them. A second property or a trust structure can shift the threshold and rate entirely. Strata special Levies are even less predictable. Lifts, cladding repairs, waterproofing, roofs, and common area work can generate bills that arrive without regard for what your yield spreadsheet says. Vacancy is a cost investors account for in theory and underestimate in practice. 2 weeks empty between tenants plus a letting fee of 1 to 2 weeks rent plus cleaning and minor touch-up work before a new lease can erase a month of surplus. Reletting fees vary between agencies. In a strong rental market, vacancy is short, but the changeover cost never disappears. In the full cost model, it is a recurring line item, not an edge case. Even with a property manager, investment property is not passive income. You approve every repair above the agency's limit. You review statements, handle tax decisions, review lease renewals, and field questions under stress when something fails at an inconvenient time. None of that time appears on a rental schedule, and none of it reduces your tax bill. It is the invisible holding cost that most spreadsheets never capture. Negative gearing lets you offset a rental loss against your other income. That reduces your taxable income, which is genuinely useful. But the reduction is worth your marginal rate, not the full amount of the loss. A $13,800 rental loss at 37% saves roughly $5,100 in tax before Medicare levy and other personal adjustments. The investor funded the $13,800 cash shortfall during the year. The tax benefit cushions the loss. It does not eliminate it. The ATO rental schedule requires every income and expense figure to be backed up with documentation. Keep agent statements, loan statements, insurance documents, body corporate notices, land tax assessments, repair invoices, and receipts. The most important distinction is between a repair and an improvement. Replacing a broken hot water system with an equivalent unit is likely an immediately deductible repair. Upgrading the bathroom is likely a capital improvement. It affects the cost base for capital gains tax rather than being immediately deductible. When you sell, the costs reappear. Agent commission typically runs 1 to 2% of the sale price plus GST. Add advertising and photography, any styling or presentation work, conveyancing on the sale, loan discharge fees, and repairs before listing. Capital gains tax then applies if a taxable gain arises. The gain is not simply sale price minus purchase price. The cost base can include certain acquisition, holding, and selling costs, depending on what has already been claimed as a deduction along the way. This is exactly where a registered tax agent earns their fee. Before buying, 6 questions are worth answering with actual numbers rather than estimates. What are the entry costs using the current official stamp duty figures? What does the full holding cost stack look like with realistic rent and vacancy included? What happens to cash flow if rates rise by 2 percentage points? What is the realistic tax benefit at your actual marginal rate? What are the exit costs and the likely CGT position? And does the property still make sense if capital growth runs at 3% a year rather than the long-run average? This is general information only. Investment property tax rules change and your personal situation matters significantly. Before buying, speak with a registered tax agent, a mortgage broker, a conveyancer, and a financial advisor. The numbers here use published figures for 2026. Verify them at the source before you act.